So the Fed raised interest rates by 0.25% this past quarter, and as a result, we really saw short-term rates move faster, move higher than our long-term interest rates, and that flattened the yield curve. So should we be concerned that we're seeing a flattening of the yield curve and that really long-term rates aren't responding to these Fed rate hikes?
I think we should be, but not right now. So we're still early on in this flattening process. And as you mentioned, the Fed raised rates, and that moves the short end of the curve higher. Generally, in a normal environment, rates move up together. But what we saw was, as you mentioned, longer term, five-year, 10-year Treasury type bonds really barely moved higher. And I think what we're seeing is it's really an issue of supply and demand. So if you look overseas, interest rates are extremely low in Europe, in Asia, et cetera. Very, very low interest rates. So if you're looking for a safe haven investment, Treasuries still look attractive. So the demand is there, and it's kind of keeping a lid on rates from rising because you have buyers out there, you have willing buyers that are interested in the space. So the yield curve is flattening, and that's normally bad because essentially when the yield curve flattens, what that means is the market is pricing in some sort of economic slowdown or recession where the Fed's going to have to start cutting rates. And when they cut rates, then the yield curve steepens again. So we're flattening, and normally you would say, oh, that's, the Fed's going to cut rates, we're going to see this happen. No other indicators indicate that we're heading toward recession. So the probability of the Fed cutting rates in the near future is very, very low. So I don't think you want to interpret the flat yield curve as the market being nervous that the Fed's going to have to cut rates. I think it's more of a supply-demand issue. And in that environment, rates moved up across the board, so fixed income didn't perform very well. We saw declines in most of the indices. The areas of the market that actually held up the best were high yield and floating rate because they have a higher yield. We saw municipal bonds actually hold up well because supply is so low. But for the most part, rates did move higher. I'm not nervous about the flat yield curve yet, but if it were to invert and we saw other signs that a recession was on the horizon, then I think you want to start getting nervous and playing a more defensive positioning in your portfolios.
Thanks, Darren. And thank you for joining us.